Hi, good afternoon and good morning. Welcome to Deloitte Financial Reporting Updates, our webcast series for important issues and developments related to accounting frameworks. Today we present Bringing Clarity to the SEC, 2014 highlights from the AICPA National Conference on Current SEC and PCAOB developments. My name is Andrew McCartney, your host for today's webcast, and I'm joined by others from our Canadian firm. A couple of items before I tell you about our agenda and introduce our speakers. In the lower right-hand corner of the screen are the webcast links, including a link to download Deloitte's Heads-Up Alert, link for webcast assistance, and Deloitte updates upcoming sessions and archive sessions. If you have a pop-up blocker on your computer, you'll need to disengage it in order to download the materials or participate in our polling questions. For those of you who know of colleagues who could not attend today's live event, they can simply register at any time the same way you did, and they'll be able to view the archived webcast within 48 hours after this event ends. So please feel free to invite them. In addition, although you're on listen-only mode, you can ask our presenters content-related questions at any time by entering your question in the box at the bottom of the screen and clicking Submit. We'll do our best to respond to all your questions. We also have interactive polling questions that will appear throughout the webcast on your screen. Again, we invite your participation by simply answering these questions on your screen. A summary of the results will be provided on the screen shortly after. Now let me introduce our speakers and discuss the agenda. As some of you already know, the ASP conference spanned 3 days ending last Wednesday, December 10th. The purpose of this webcast is to review the highlights of the conference. The slide deck will not be available for download. However, you may access a Deloitte's Heads-Up publication on the conference which summarizes the topics covered today. I'll start off by providing a brief executive overview of the conference. Then you'll hear from Deanne Kennedy, who will discuss regulatory matters. Sean Morrison will follow and discuss accounting topics. And finally, Jason Novakovski will discuss some of the auditing developments. You can read the bios of our presenters and access the agenda and technical support in the navigation area on your screen. Please keep in mind we have a lot of material to cover in the 60-minute webcast, so it will be covered at a high level. As I mentioned earlier, and time permitting, we will conclude with a question and answer period. I'd also like to remind our viewers that our comments on this webcast are our own views and do not constitute official interpretive accounting guidance from Deloitte. Of course, you know, before taking any action on any of these issues, it is always good to check with a qualified advisor. So from the executive summary perspective, the matters that we will look to cover today are rethinking financial reporting and disclosure effectiveness. This was a significant conference theme this year. Registrants were urged to look at the disclosures to ensure they are relevant, focused, and balanced on material items so as to clear out any clutter within the disclosure. In respect to SEC staff speeches, this year professional accounting fellows from the Office of the Chief Accountant spoke at the conference. Deanne and Sean will cover a lot of the material later in more detail. However, in general, the chief accountants who attended did remind us that speech GAAP is only meant to provide transparency in how the staff analyze complex matters rather than providing an answer, and thus caution was advised to not place undue reliance on these speeches as well as other non-authoritative guidance. There was, as normal, significant discussion on accounting and financial reporting topics. Notwithstanding many of the topics do not appear to be new, some were discussed through a new lens and new perspective on how the staff may approach an area of interest. Particular interest, for example, is being paid to segments, in specific looking at who the CODM is, the chief operating decision maker, and what the CODM reviews. In terms of accounting, there's also a lot of discussion of the new revenue standards and other topics such as income taxes, fair value, and pensions. Sean will cover these in more detail as we progress through the presentation. In terms of auditing updates, a focus of the conference was increasing transparency and improving audit quality. In terms of the new standard setting, there was a continued discussion of the new auditor's reporting model and the disclosure of engagement partner and other participants in the audit. And Jason will cover these further as we progress. The SEC also did introduce another potential IFRS option under consideration for U.S. registrants, which Deanne will elaborate on in her update on the regulatory matters. During the conference, this topic did get a lot of airtime, although it doesn't seem like no conclusions have yet been reached on the topic. So on the topic of IFRS, let's move on to our first polling question. And remember, you need to disable your pop-up blocker if you have one on, if you want to take part in the polling questions. And we'll ask everyone online to participate in the webcast in these questions, so please answer to the best of your ability as the questions are framed. So polling question 1, the SEC representatives did remain open to IFRS, and we'll hear about new alternatives shortly. Before we share the news, do you think IFRS will eventually be adopted by U.S. domestic registrants, and if so, when? So the options are yes in the next 1 to 3 years, or yes in 4 to 6 years. No, U.S. GAAP will remain indefinitely, or final one is undecided. So while we wait for the results of the polling questions, I'd like to remind you that today's webcast may be counted towards your continuing professional education. If you stay with us for the entire hour, you can receive 1 hour towards your yearly total. This applies to those in public practice as well as those working in industry. We do not issue certificates for the webcast, but your email registration confirmation can form part of your documentation in support of your attendance. So at this point, if we could look at the results of the polling question. So about 50% said no, U.S. GAAP will remain certain, and a number believe, about the other half believe that at some point the SEC will allow IFRS for U.S. domestic registrants. So with that, I will pass it over to Deanne, and maybe she can give us what the real answer is. So Deanne, over to you.
Thanks very much, Andrew. So today I'm going to spend some time discussing the regulatory matters raised at the conference last week. And to continue on the IFRS theme, if we just flip to the, domestic registrants and the use of IFRS. So the big question, will IFRS be accepted in the U.S. for U.S. domestic filers? The message from the conference, in my personal opinion, was not too warm or welcoming. And as you may have recalled, a few ideas floated around in the past years on how to incorporate IFRS into a domestic filing. So, for example, full adoption, there was voluntary adoption, and I'm sure we've all heard of the Condoresment approach. This year, those options seem to have faded, and now the new idea, IFRS supplemental information. And this was the approach that was really introduced this year as the new alternative. So for an example, if a U.S. domestic filer who does file in U.S. GAAP, as that is what is required, wishes to disclose IFRS financial statement or financial information, they may do so supplementally in addition to their full U.S. GAAP financial statements. So this is a really interesting concept. There's obviously a lot of considerations here. A couple, just to name a few, where would the information reside? Could this IFRS financial information be considered non-GAAP? Would there be any assurance on this information? So the underlying tone of this approach was really to make sure that the domestic registrants were still providing comparable, high-quality information that was useful for decision-making. So the IFRS, the supplemental option, wasn't introduced, so do expect to hear more of this alternative as the SEC explores the avenue with the various stakeholders. So moving on to another theme, as Andrew mentioned, another hot topic at the conference was the theme of disclosure effectiveness. It was referred to at the conference as the call to action. Other terms that you may have heard over the last year, disclosure efficiency, avoiding disclosure overload. So really phase one of the disclosure of efficiency project is to review certain rules and regs, so including SK and SX, and to issue a concept release on how these rules can be simplified and modernized. As many of you know, even in the context of the foreign rules and regs, a lot of them are written in the context of a U.S. GAAP reconciler, which is really hardly ever seen anymore. So the SEC has stated that effective disclosures are those that are clear, concise, they focus on matters that are material and specific to the registrant. And appropriate emphasis is critical. So really effective disclosures emphasize matters that the registrant believes to be the most relevant and material, and they de-emphasize or perhaps exclude entirely matters that aren't. So what does this mean from a financial statement perspective? The staff mentioned there are basically two approaches that they have heard of and are considering evaluating. And the first approach basically is the all-in approach, and the second being the piecemeal approach. And it's really important before I go on to note that the staff did not conclude on which approach should be used on this matter, and it's still being analyzed. So really this was just a discussion point of what was being seen in practice. So basically the two schools of thoughts are, one, the all-in, and that basically means once you're within scope of an ASC topic, full disclosures are required. And any disclosure that would be missing would really be considered an error. And the second option being the piecemeal approach. And that would really allow an entity to consider disclosure requirements on a line-by-line basis. And the omissions, if they are not material, would not be errors. A really good example of this is a biz combination. So if you have a material business combination and you're within that ASC, full disclosures are required, including, for example, pro forma disclosures, which in practice we see many registrants omit based on the concept that the pro forma information is not material. So this, in fact, could be considered an error due to the omission of it under the all-in approach, where under the piecemeal approach, the pro forma disclosure would not be considered an error if not disclosed if it was not material. So in practice, I see both approaches when it comes to biz combination disclosure. So again, another topic to stay tuned on what will be released on the financial statement materiality discussions. From an MD&A perspective, there is a requirement to disclose known trends and uncertainties that are reasonably likely to have a material impact on the registrant. And the staff really discussed a two-pronged approach for MD&A disclosures. So a registrant is required to disclose unless they, one, determine it's not reasonably likely that the trend or uncertainty will occur, or two, a material effect is not likely to result. So again, focusing on when we're looking at MD&A on a two-pronged approach. So staying on the themes of business combinations, the staff actually spent a lot of time discussing the issue of business combinations. And the key takeaway from this slide is that the determination of if an acquisition constitutes a business or an asset can actually be quite complicated, and the staff is continuing to see that registrants are continuing to struggle with this decision. And the determination is this determination, so asset versus business, is really a trigger point to determine if, for example, non-issuer financial statements would be required in a filing, and obviously if you need full BizCom disclosures. So it's really an important decision, and it shouldn't be overlooked too quickly. Another key takeaway, it's really important to recognize that the definition of a business is different in GAAP than it is in the securities rules. So just because you've analyzed under U.S. GAAP or IFRS, for example, you still need to look at your relevant securities rules. Just as an example of a asset versus business that routinely comes up in the real estate industry is in an apartment building. So perhaps if you purchased an apartment building and there are underlying lease agreements that are in place, perhaps that's evidence that a process is in place to generate an output and revenue. But perhaps if there was no underlying lease agreements, then perhaps the right answer might be it's an asset acquisition. So I'm not going to spend too much time on the remainder of the slide and the black line presentation of certain expenses. We typically don't see that too often in Canada, but if you are in that situation, I would definitely urge you to consider the staff's comments from this year's conference in your presentation. So let's move on to goodwill impairment. So as we all know, goodwill requires annual impairment tests to be performed on the same date each year. And if you choose to change that date, it is considered a change in accounting policy. And for those of you that file on domestic forms, so if you're on a Form 10K, you will be aware of the requirement to file a preferability letter when you change your accounting policy. So historically, the staff has requested letters to be filed if the registrant was changing the date in which it performed the annual goodwill impairment test. At the conference, the staff indicated that one may be able to support that the date change did not have a material effect, so it didn't have a material effect on the underlying internal controls or on its assessment of the goodwill impairment. So in those situations, if there is prominent disclosure in the financial statements of this date change, then the preferability letters need not be filed. Obviously, you don't want to be changing your date all the time because then the staff may still ask you questions. So moving on to the next interesting topic that Andrew alluded to is segment reporting. And segments is a recurring focus area every year, but if we focus on the first bullet point, the staff indicated that it might be one of the most important financial statement disclosures. And definitely this year it's no exception, and it's really interesting to see the new perspective the SEC staff is taking on reviewing these disclosures, perhaps moving away from focusing so much on the reports provided to the CODM, because maybe that's really not the way that the businesses are being managed and how the decisions are really being made. So let's focus on the CODM package to really a more robust view on the full suite of information moving around in an entity. As Andrew also mentioned, the question of is, for example, the CEO really the CODM? And if it, or perhaps, so the question, is your CEO really the CODM, or is it really perhaps maybe another COO perhaps who really manages the day-to-day operations while the CEO may review information quarterly? And if it's your COO, for example, is that suite of information the COO is looking at really different than those CEO packages? So really expect more focus on understanding the management structure, supporting the conclusion of who the CODM actually is, and what information is really being used for the operations. And just in general, you always want to ensure that you're re-looking at your segments. So if you've had a change in your business, for example, the BizComs that we just talked about, or perhaps a change in your CEO, again, triggers that maybe your segments have changed. There was caution that if you have one reporting segment, make sure that you can support that one segment conclusion, that it makes sense. For me personally, I always look at the MD&A as a sanity check. So when I review the financial statements and I look at one segment, does that really line up with the MD&A discussion? So again, segments is a new evolving area of the staff, and you want to ensure that you have considered this as you go through your year-end process. So moving on to cash flows. So the staff noted that there's a recent trend of restatements resulting from errors in the cash flow statement. On this slide, there's a laundry list of considerations. However, I think the most important message is really to spend enough time on the cash flow statement. It is a full statement, just like the balance sheet or income statement, and it really shouldn't be approached just like a mathematical exercise. The staff noted that often it is not complex areas of GAAP, so it's not extremely difficult areas to understand, so really ensuring that registrants are taking enough time to prepare and review this financial statement. So just moving on to the next slide, again, there's a lot on the slide in terms of areas that could result in frequent restatement of the cash flows, but just to pick out some that I commonly see, and again, not complex areas, ones to focus on when you're going through your cash flow statement: gross versus net presentation. So, for example, making sure that everything that is netted on your cash flow is allowed to be netted. Restricted cash is always a high comment area, so where is it in the cash flow classifications? NCI classifications, for example. And again, from my perspective, the cash flow is always a place you can comment on disclosure considerations. So just to take away, it is becoming a frequent restatement area, not complex areas, so just make sure that adequate time is spent on your cash flow. So very quickly, I'm going to move on to the staff-covered IPO and spin-off transactions. And I spent quite a bit of my time working on transactions, and one thing is definitely certain: the transactions are typically always complex. They're never alike, and adequate time needs to be spent on the technical accounting issues for the transaction. And one area that the staff did focus on this year is that making sure that you have the right financial statements in the document, and this is definitely an area that may be overlooked when you're sizing your transaction. So it can get very complicated, and you actually may end up with financial statements that you didn't initially think of. So making sure that you do take enough time in analyzing what financial statements should possibly go into a transaction. The staff also did spend some time on predecessor financial statement scenarios. Again, making sure that you take enough time to identify those, as well as any additional non-issuer financial statements requirements, such as acquisition financial statements or equity method financial statements. So again, just ensure that you're focusing on these important considerations up front at the start of a transaction. And just to take away the final bullet on the slide, a lot of focus continues to be on cheap stock. So if you are going through an IPO, you are likely to get the cheap stock comment. And this is really where the pre-IPO value is significantly lower than the prices observed in the transaction shortly before the IPO. So just a reminder, there's good guidance in the financial reporting manual on cheap stock. And again, the staff at the conference encouraged entities to engage their valuation specialist to consider the transactions to sufficiently document their assessment of the impact of the transactions on their pre-IPO stock value. And just flipping on to my last slide, I know Jason's going to cover internal controls in the auditing section a bit later, but I just wanted to raise the concept of internal controls being a new hot topic area for consideration. And the focus of the staff is really on where could you have a material weakness. So again, I'll let Jason go into more detail, but when I review the financial statements, and if I see, for example, a blanket statement footnote about comparative figures have been recast for comparability, usually this can always generate a question. It's a bit of a vague footnote, and you don't want to lead the SEC down a path to question, what does this footnote really mean? Why were numbers restated or reclassified? Is it really errors? Could it be material, not material? And ultimately, is there an internal control issue? And the final point on the slide, just the COSO framework. So the staff did mention that the 1992 and 2013 frameworks will be accepted for this year end. However, ensure that you have clear disclosure on which framework was used. As well, the longer a registrant may use the superseded 1992 framework, perhaps the higher the likelihood of the staff asking questions. So that concludes the regulatory matters section, so I'll pass it back to Andrew.
Thank you, Deanne. So at this point, if we could move to our second polling question, please. So the question reads as follows: what COSO framework is your company using for this fiscal year? 1992, the 2013 framework, or the question is not applicable to you? So while we wait for the results of the question, Deanne, I'd like to ask you a question
Sure.
in respect to material weaknesses. So it's as follows: We understand that regulators are paying more attention to material weakness identification. Is this interest only in the context of identifying a material financial statement restatement?
Yeah, I think that's a really good question, because in the past, I think the staff, obviously you would see a material weakness identification if you had a material financial statement restatement. But I think the question is really being more focused on where a material weakness could happen. So, for example, if you have in your footnote disclosure an immaterial error correction, that could also generate the question of, could a material weakness exist? So I think it's both it's both in material and immaterial restatements.
Oh, that's great. Thank you. Can we see the polling question results, please? So I'll ignore the bottom 45%. So of the 55% or so, approximately majority or 80% of those actually responding to the question have indicated that they are following 2013. So that's encouraging to see. I have heard a number of other companies that actually aren't, so it's great to see people moving on to the new framework. So at this point, I'd like to pass over to Sean Morrison, who will take us into our next section of the webcast today. Over to you, Sean.
Thanks, Andrew. I'm going to spend the next 15 or 20 minutes or so talking about a number of different accounting topics that were raised at the conference. And I should note this is going to be a bit of a potpourri, and I should note that the majority of the topics were raised by the SEC staff in the context of U.S. GAAP, but I will try to highlight the relevant IFRS considerations as we go through each of these topics in turn. But to start with, why don't we start with consolidation? A number of comments were raised by SEC staff members around the U.S. GAAP consolidation model for variable interest entities. And then the first issue that was raised was with respect to the evaluation of joint power. This is particularly with respect to the identification of the primary beneficiary of a VIE when there's joint control by several related parties. In these situations, staff noted that what's really critical is to identify the significant activities that affect the economic performance of the VIE, and to assess whether joint consent is required for each of those significant activities. It does presume that for multiple unrelated parties to have joint control, each party would be required to provide consent over decisions governing each of those significant activities, and that would be contrasted to situations where perhaps one of the activities was governed by unilateral consent by one of the individual parties, in which case it would put some pressure on the conclusion that you actually had joint control. Second issue was with respect to power when the decision maker is acting as an agent. The staff noted that when a registrant has determined that a fee paid to a decision maker is not a variable interest, the registrant may need to continue the consolidation analysis by evaluating whether the substance of the arrangement identifies a party other than that decision maker as the party with power. It's an area of complexity, and it's also one, I think, where the analysis would be expected to be highly judgmental and would require careful analysis. And the last and final topic that was raised was with respect to the related party tiebreaker test. The staff discussed whether related parties under common control are always required to perform that tiebreaker test. And as a matter of background, that tiebreaker test refers to the piece of U.S. GAAP consolidation guidance where a company is required in certain situations to determine which party in a related party group is most closely associated with the VIE that's being evaluated for consolidation, and therefore becomes the VIE's primary beneficiary. The staff noted that while entities must carefully consider situations involving related parties under common control, you don't always need to consider the tiebreaker test, and really that test really only comes into play when there's no party in the common control group that individually would meet all the characteristics of a primary beneficiary. Moving on to the topic of equity, and I think for anyone on the line that deals with U.S. GAAP liability equity issues, certainly an area of complexity, and I think the same issue would be relevant and appropriate under IFRS as well. The one topic that was raised at the conference, though, was with respect to the accounting for amendments to or exchanges of equity classified preferred stock. For those that are familiar with the debt guidance under U.S. GAAP, and we'd have similar guidance under IFRS and IAS 39, but there's an old EITF, which is the ITF 9619. It's now codified within AAC 470-50. That really says, if you're looking at changes you made to a debt agreement, you really need to look at the terms before and after, and if they're substantially different, that would suggest you've actually extinguished the old debt and taken on new debt. But if the changes weren't substantial, then really you've probably only modified that old debt arrangement. And in assessing what is substantial, there's a number of factors that you need to consider, but the most significant one is really a test where you need to look at the present value of the cash flows under the new instrument versus the old, compare them. If they're different by more than 10%, it would suggest you've actually extinguished the old debt arrangement. If it's less than 10%, it would suggest you've actually only modified the old arrangement. That guidance is fairly clear. It's fairly well understood. The question now is, would I do in the exact same circumstance when I'm dealing with something that's preferred stock and preferred stock that's classified with an equity? If you got preferred stock that's classified as a liability, you'd follow just that same debt guidance that's already out there. So if you have equity classified preferred stock, you've modified it, or you've exchanged it for a new share issuance, the staff refer to really 4 approaches that are used in practice, and each of which is available for use. First, the qualitative approach, and just given its name, what it really does is requires one to really look at the significance of what's been added, what's been removed, what's been changed, looking at the business purpose of the changes and how those changes may influence the economic decisions of the investor. If those collectively are deemed to be significant, it suggests you have an extinguishment. If not, you'd have a modification. Fair value, similar to the debt approach, you'd be looking at the changes in the fair value of the 2 instruments before and after. If the change in fair value is in excess of 10%, it would suggest extinguishment. If not, it would suggest modification. Cash flow approach is very much the same thing, except you'd be only looking at the changes that are arising due to contractual cash flows. And lastly, legal form approach would look at whether or not you've actually legally exchanged new instruments. If you have, it would suggest extinguishment. If not, it would suggest modification. In discussing that approach, though, the staff was very clear, though, to note that in their view, in most circumstances, the legal form should only be one factor of the analysis, so therefore some caution with that approach, but in certain circumstances it can nonetheless be appropriate. Fair value is always an area of topic, and for those of you that have dealt with comment letters from the SEC staff, you've probably gotten comments on fair value. They continue to raise comments. Those comment trends are not necessarily all that new. They're raising comments in the same areas as in the past. They're looking at things like initial fair value measurements and business combinations, so how have you fair valued the items in your PPA, as well as fair value as it comes into play for impairment testing. So if you're under US GAAP, getting into your Step 2 test, if you're looking at IFRS, certainly looking at have you undertaken your fair value considerations, if you're looking at fair value as a recoverable amount for your CGUs. Well, the one they're probably focusing on more, and just given where we are in terms of certain economic factors and indicators, is really looking at whether or not there are inputs that have been considered as impairment indicators because of the existence of red flags. So looking at things like, do you have a depressed stock price that may have brought your market cap down below book value? They're looking at environmental events, so certainly what we're seeing now in terms of the price of oil, iron ore prices, coal prices, other commodities, as well as more routine things, losses of major contracts, significant changes that are adverse from a technological perspective and so forth. If those exist, I think the staff would certainly raise a comment if it's not clear to them how those considerations have been factored into your assessment of impairment and determination of fair value. Some other considerations that they're looking at, they'll always look at how you've leveled fair values within level 1, 2, and 3, but more importantly, what's the carry-on impact on your disclosures? So if you end up with a lot of things within level 3, they'll want to make sure you're comfortable with level 3, as well as ensuring that you've provided all the required disclosures for those level 3 assets and liabilities that are stipulated by IFRS 13 or FAS 157. And final, a reminder around making sure registrants don't omit disclosures related to items that are carried at fair value on a non-recurring basis. So if you get situations where you've written an asset down to fair value that say is your recoverable amount under IFRS within I-36, that is caught by the fair value disclosure guidance, as would long-lived assets that are reclassified to held for sale and have been written down to estimated fair value would also be caught by that same guidance, even though those would not be assets that would be carried at fair value on a recurring basis. Financial instruments, always an area topic by the SEC staff. I think the one topic they raised here that was specific to novations of derivative instruments. So the issue here is, you can have situations where a counterparty to a derivative contract may be novated in terms of the rights and obligations may be novated and legally transferred to another entity. It can happen if, let's say, you've been acquired and therefore you need to transfer all legal agreements to a new legal entity. Could happen because you've done a legal entity reorganization. It could happen for a number of different reasons. But the issue is that if I do that, the question is, what happens to my hedge relationship? Do I discontinue hedge accounting or can I carry it on? The staff confirmed their view that typically, and I would stress the word typically in most circumstances, novations would trigger discontinuation of hedge accounting because that would be viewed as the legal termination of the original derivative instrument. However, there can be situations where they would not challenge a view that the novation did not trigger the discontinuation of that relationship. And that would be, critical things to look at. You need to make sure that none of the critical terms of the derivative have changed, that the hedging relationship continues to be highly effective. And the novation really occurred in one of three defined circumstances. The first, the derivative counterparty merges with and into a surviving entity that assumes all of the same rights, all the same obligations that existed under a pre-existing derivative instrument of the merged entity. Second situation would be where the reporting entity's derivative counterparty novates a derivative instrument to an entity under common control with a derivative counterparty. Or the third situation would be at the inception of the hedging relationship, it was contemplated and contemporaneously documented that at some point there would be a novation to a new counterparty during the hedging relationship. On an unrelated topic, there's the situation around hybrid financial instruments was raised. So hybrids, you're looking at instrument that's part equity, part liability. Common examples, convertible debts, convertible preferred shares, redeemable common shares, and the like. There can be situations where, because you've got a hybrid and let's say you got a component that meets the definition of a derivative, so it's got to be included within equity or within liabilities and then carried at fair value. There can be situations where when you determine what that fair value is, that number is actually higher than the actual cash proceeds that you received on issuance. It doesn't happen often, but it does happen. In those situations, the staff confirm that in terms of answering the question, what do I do? They said the first thing is to make sure you got your fair values right. Go back into those estimates, make sure they're appropriate under the fair value guidance, and that would be either IFRS 13 or FAS 157. Make sure you're conducting things at arm's length, or you're dealing with a related party transaction that perhaps wasn't at fair value. And if you're at arm's length, look at all your critical terms and assess whether or not you actually have another instrument within that arrangement that needs to be separately accounted for. Moving on to income taxes. Comments here, again, continue to be very similar to what we've raised or seen in the past. The usual suspects are the four items that you see on the slide. Continue to ask a lot of questions around cash that's held offshore in a foreign subsidiary. And this has probably come up now at least probably each of the last 3 years at least at the conference. And the issue here is a lot of companies that have multinational operations may take tax positions, and rightly so in accordance with IFRS or US GAAP guidance, where the presumption or the assertion is being made that that cash will be permanently reinvested in that foreign subsidiary, and therefore deferred tax liabilities are not being recorded. The issue the staff raises, though, if that's the case, that you really have tied up this cash offshore, is that putting a pressure on your liquidity status? And if so, should that liquidity issue be disclosed because you can actually get access to that cash? Valuation allowances of deferred tax assets is always an area of focus within income taxes. Really looking at, do you need a valuation allowance? Do you have the right valuation allowance? Should you reverse the valuation allowance given your positive negative evidence? Rate reconciliations probably is getting more comments than ever. Really looking at the clarity of disclosure and presentation. Are the line items clearly identified? Do you have enough? Are they descriptive? As well as, are you netting material amounts within the line items of your rate reconciliation? And if you are, perhaps you should be breaking those out. And then lastly, with unrecognized tax benefits, generally looking at compliance, making sure that the UTBs have been identified and measured in accordance with the US GAAP guidance that was housed in what was formerly FIN 48. And lastly, just some other comments were also raised generally about tax provision disclosures. It's an area where the staff continue to see a lot of boilerplate. They don't like boilerplate. and they're encouraging registrants to get to something that's not boilerplate and is focused on the company's facts and circumstances. Moving on to pension and other post-retirement benefits, and specifically issues around mortality rates. Now, the good news seems like on average, all of us are living longer, and that's certainly a positive fact. But we put that in the context of this area of accounting. Anyone who has a defined benefit plan or is responsible for the accounting for a defined benefit pension plan would know, that simple assumption around mortality is one of the key inputs in the valuation of the pension benefit obligation. Demographically, it's pretty clear we are seeing improvements in longevity, and that fact was supported by updated mortality tables and improvement scales that were included in the guidance issued by the Society of Actuaries in October 2014. The issue then is, well, we've got this new data, these new tables. Am I required to incorporate those in my calculation of my defined pension benefit obligation? And the general view is probably you should. However, it was acknowledged that there can be situations in which an entity's mortality assumptions may actually differ from those in the Society of Actuaries tables, and noted that in those cases, you'd need to demonstrate that your estimate of mortality was based on the specific merits of your pension plan's population. And therefore make sure that disclosure was clear. It was also further elaborated by another member of the SEC staff that, there are divergent views among actuaries about the projections that were included in the tables, and that other equally reasonable projections are possible, but if so, those positions would need to be supported and disclosed as appropriate. Revenue recognition is a couple points. Just firstly on the existing guidance. I say existing because, as many of you would know, we do a new joint project that issued new revenue recognition guidance under both U.S. GAAP and IFRS that is yet to be adopted. But under the existing standards, so the existing SAB 104 and related interpretations and elsewhere, the whole issue of principal versus agent. So for those of you that are still live in the pre-codification world like I do, we're talking about EITF 9919. Similar principles exist under IS 18, but we certainly know the same prescriptive guidance. But there was some pretty clear guidance in U.S. GAAP, and still is, around what are the 8 factors that you need to consider when you ask yourself the question of, is it more appropriate for me to present my revenue on a gross basis instead of a net basis? Those 8 factors haven't changed. Things like who's the primary obligor, who has inventory risk, who sets prices, who is responsible for changing products or performing parts of the service, and so on and so forth. The issue wasn't so much the gap itself, but was the fact that there are certain new emerging industries where this guidance is becoming difficult and complex to apply. And we're really looking at a lot of e-commerce businesses, and the one that the staff focused on was really online advertising. And they noted, if you were going to apply the guidance, the same guidance still applies. They're still going to look at it the same way, which means while no individual condition is more heavily weighted than others, there tends to be more focus by the staff on who the primary obligor is, as well as who has inventory risk, and those would still be equally applied to e-commerce industries. That said, they did acknowledge that sometimes it can be difficult to identify who the primary obligor is in some of these industries, and in those cases, they may look at other factors like who has latitude in establishing pricing. From the new standards perspective, 2 points to note. First, there's likely going to be more judgment and different judgments required in the new standard in areas like measuring and constraining variable consideration. That was kind of a thought that was thrown out there, and for registrants and preparers on the phone, as you look at those new judgments that apply to your facts and circumstances, you may need to consider whether or not you need new systems, processes, or controls to support those new judgments. On the application of the new standard, there is a resource group called the Transition Resource Group, or TRG for short, that was formed jointly by the ISB and the FASB. It has members that include preparers, auditors, as well as users representing, a bunch of different industries as well as geographical locations, including Canada. We are represented, and they will look at a number of different issues that are worth consideration. And right now, as the slide suggests, we have 28 submissions of questions. For preparers on the line, if you have questions that you think should be considered, you should certainly feel free to submit those for consideration by the TRG. Moving on to some other accounting and financial reporting matters. Definition of joint venture, just quite quickly, this is a very finite issue, so I'm not going to spend a lot of time on it. Just the one thing I would note is if you are in a situation where you're looking at the formation of a joint venture under U.S. GAAP, you will note that there's very little guidance. There is a number of different positions that are taken on how to present the basis of the assets in that entity. Sometimes it's full basis, sometimes a full step up, I should say. Sometimes there's a partial step up, sometimes it's predecessor basis. There's no real rule telling you what to do. The staff just wanted to remind folks that if that is relevant to you, look at what the purpose of the transaction was. If that purpose is more consistent with the definition of a joint venture under ASC 323, that should be a relevant data point to your analysis. Conversely, if it's more akin to a business combination because it's really a merger or put-together transaction, that could be a different consideration point that you'd need to consider. On the issue of software development costs, nothing new here. Just a reminder for folks that if you are looking at incurring development costs for the development of software that is to be used for internal purposes, the model there is different from what you do when you're developing software that's going to be sold, marketed, or otherwise or leased, and that can impact the timing when you start and stop capitalization. So just be forewarned that you shouldn't apply the same guidance in both scenarios. And also pay particular attention to situations where you may have actually incurred the cost to actually use it internally, but you then subsequently sold it. If you're going to recognize the revenue, that's fine, but you first need to take those proceeds and net them off against the costs you've previously capitalized. A heads up to those in the oil and gas industry. The staff did note, they are seeing obviously what the rest of us are reading in the papers every day around the decrease in oil prices. Heads up to folks, there are a number of accounting considerations you'll need to be making around things like impairment, going concern, fair value measurement. But from an MD&A perspective, the SEC is going to presume likely in most circumstances that change would be considered a known trend or uncertainty that should be addressed in MD&A. And you may also supplementally want to consider whether or not that gives rise to a new risk that should be included in your discussion of risk factors. From an accounting standard setter perspective, we heard from representatives of both the FASB, Russ Golden, who's the FASB chair, has been in place for about a year now, as well as Ian McIntosh, who's the vice chair of the ISP, and he spoke in lieu of Hans Hubervorst, the current chair, who was unable to attend the conference. I think overall, if you looked at the remarks, you saw, again, continued support for the ongoing convergence projects that are still underway, but some particular comments that I think those of you that deal with U.S. GAAP would appreciate. There's acknowledgement by the FASB that U.S. GAAP is complex. There are a number of simplification initiatives underway, trying to reduce the complexity, as well as looking at building a more comprehensive conceptual framework that will help bridge gaps, hopefully, as well as minimize consistencies. There's also a number of standard-setting projects that are underway by both boards, and for those interested, I encourage you to take a look at the FASB and ISB websites for a status update on the technical standard-setting agenda on both sides. And lastly, before I pass things back over to Andrew, just as Andrew mentioned in his opening remarks, there was a number of comments made around SEC speeches. There was a time where the SEC set a lot of standards through speech making. That doesn't tend to happen anymore, but as Andrew mentioned, if you're looking at a speech, just recognize it's meant to provide a purview into how the FCC looks at an issue versus providing you with an absolute answer. The staff was asked, well, what's the shelf life of a typical speech? There's no hard and fast rule, but typically these things are probably relevant for only about 5 years before the world moves on in terms of the interpretation of the issues at hand. And with that, Andrew, I'll pass it back over to you.
Great. Thank you, Sean. If we could jump to the next polling question at this point in time. So the question reads as follows. As mentioned, the new revenue standard has many implementation challenges, and there is a discussion of FASB possibly delaying adoption. What is the expected impact of the new U.S. GAAP or IFRS revenue standard on your company? No impact expected, an impact expected but not significant, a significant impact expected, or not sure, not applicable. So as we wait for those responses, Sean, I'll just have a quick question for you. And speaking of the revenue standard and expected impacts, there's been a lot of discussion on how the revenue standard may impact a company's MD&A disclosures, for example, quarterly tables or the annual tables. the 5-year table that exists. Is there any insight as to how a company may approach these disclosures?
Yeah, there's some guidance that has been provided. If I look at the one that people talk about the most, it's really the 5-year table. And I guess the staff's been clear they wouldn't require you to push the standard back to the earliest of the 5 years. What they really expect is probably disclosure that mirrors what you've done in your financial statements. So if you choose, when it comes time to implementation, to use the full retrospective method, then likely expect to have the most recent 3 years on the same basis as standard in terms of revenue. Conversely, if you elect the modified transition basis, then they'd only be looking at the most recent year being under the new standard. Regardless, though, they'd want to see disclosure, so one would be able to clearly understand what the basis of that presentation is.
Great, thank you. If we could jump to the response to the polling question, please. So it appears that a large number expect there will be an impact of some sort split between not significant or significant impact and a number no impact at all. So possibly they're in a very simple revenue environment, but that's interesting just to note that. So at that point, Jason, will move over to you for the final pieces of the presentation.
Right. Thanks, Andrew. So I'm going to take a few minutes and just talk about some of the auditing developments, and for the companies on the line, I appreciate that this is more directed at the firms. However, it obviously has a trickle-down effect in that what gets measured gets focused on, and as the audit firms are measured on this, they will continually lean on clients with respect to this. So the first thing that they spent some time on is they are committed to 3 areas this year, and the first one is that they remain focused on enhancing the reliability and the relevance of the audit. And one of the ways that you're seeing that is with the proposed guidance on changes to the auditor report, which I'll talk about in a few minutes. The other piece that they're looking at is they're incorporating a fairly robust economic analysis as they're continuing to weigh the benefits of the increased audits as audit requirements and requirements for companies, along with the costs that are associated with that. And then lastly, they are continually engaging audit committees in, even more so now than in the past, but talking with audit committee members and people that have a stake in the director environment to ensure that they're getting all the information that they need on a timely basis in order to provide oversight of the audit, as well as ensuring that management is committed to reliable financial reporting. The one thing that I'm just going to touch on quickly on this one slide is the continued cooperation internationally. As most of the people on this call are aware, the PCAOB obviously only has jurisdiction over the U.S., and the audits that are done in the U.S., and it's by virtue of agreements with other countries that they're able to complete reviews over audit firms in the other countries. And the point here is that they're continuing to be able to conduct their reviews in these foreign countries, and it's leading to increased transparency and, in their opinion, investor protection. So what really are they finding? It's interesting because a lot of this, these slides, you'll see that they kind of mirror up with the topics that the SEC is asking companies about that Sean had just discussed a few minutes ago. And why is that? I mean, largely, when you think about it, it's not that hard. It's areas that have significant judgment or are complex or are difficult to test, i.e. there's a lot of judgment and estimate, and by virtue of that, it means that it's the more complex and riskier areas of the audit. So it's not surprising that this is what we're seeing. And with respect to this, they continue to use a risk-based approach, both in selecting the engagements that they review, as well as the areas that they focus on when they complete a review of the audit firm. So things such as revenue recognition, inventory, business combinations, again, those really mimic a lot of the SEC comments that we're seeing, but more so in the context of, you know, are you sure the accounting's right? What were your judgments? How did you challenge management's assumptions? how did you apply appropriate professional skepticism, and really they're looking for a bit more of a roadmap in the audit files with respect to the judgments. One of the key ones that I'm going to talk about for just a minute here is they're continually finding that ICFR, or Internal Control Over Financial Reporting, is a challenge to auditors. And I think a lot of this is stemming from the fact that we have a lot of management review controls, and are they direct and precise enough to prevent a material misstatement, as well as what are the thresholds that people are using when they're conducting it, how is it documented, both in the client's records as well as in the audit file. So we're seeing a number of deficiencies related to that. Another deficiency is really not obtaining a sufficient understanding of the flow of transactions in order to identify and test the controls that would mitigate the risk to that account and ultimately to the financial statements. And so one of the things that they've looked at is whether or not flow charts would be a more appropriate way of documenting a lot of the processes and controls that companies have in place. And so you may see your auditors start to ask more questions related to the understanding of the business and the flow of the transactions. Looking ahead to 2015, they gave us some insight as to a couple of the areas that they're going to be looking at. The environment, obviously, it's an important area. It gets a lot of media attention, and as a result, they're going to be focused on environmental risk. The other thing is as the mergers and acquisitions markets, as well as dispositions, as that heats up, obviously there's going to be an increase in the financial statement risk associated with that, and there are a lot of projections or assumptions that are used in order to backstop the financial statement numbers that are ultimately impacted. And so what they're going to be looking at is the cash flow projections, as well as what are the controls that the companies have in place and how have the auditors tested those controls around business combinations. The other ones I'll leave kind of taken. Sean mentioned the falling oil prices, and Deanne talked about the statement of cash flows. And cybersecurity, again, that's one that's got a lot of play in the media lately, most notably with Sony and the hacking. However, again, there is increased scrutiny over, the cybersecurity at our clients, and by virtue of that, the PCAOB has started to focus on that as well. I mentioned that I was going to talk briefly about the auditor report model. It's interesting. This is actually getting a lot of discussion both in the U.S. and in Canada. There has been a derivation of this that's been used in Europe for a couple of years now, so we're starting to see where that's coming out. But effectively, what they're trying to do is enhance the relevance of the audit report and have the auditors disclose significant areas of judgment or critical audit matters as defined in the proposal. I know that there's a lot of trepidation out there from when I'm talking about it with my clients, as well as I think a number of the audit partners are concerned. However, when you think about it, what better information to provide an investor than really what is it that an objective audit firm is spending their time and attention doing, and what's keeping them up at night, and what are the significant risk areas within the audit. So that'll be interesting as it develops. I do think that there is going to be something issued in early 2015, and ultimately there will be something in place in Canada and in the U.S. with respect to a revised audit report model. It's just a matter of what that ultimately will look like. Very quickly, audit transparency. They're looking at whether or not we should be disclosing the name of the engagement partner and the names and locations and the extent of involvement of other firms participating in the audit. Currently, the audit report just says that somebody else audited this. It doesn't say who or the location. So again, they're just looking at increasing transparency of who's actually completing the audits. And again, this is new to Canada and the U.S. However, there are a number of jurisdictions across the globe that already provide this information. And then lastly, skipping back to consideration of ICFR, the identification, the evaluation, and disclosure of material weaknesses. It's interesting. What they're effectively stating is that, in their opinion, most of the time people are focused on what actually happened. And as Deanne mentioned, really the focus should be on what could happen. And it's an interesting conundrum when you're having a discussion with a client and, well, the control obviously worked because there wasn't a material misstatement. Well, but it could have happened. And so I think that there'll be more discussions of this nature as the PCAOB continues to push us along with the SEC with respect to this. So really relevant factors to consider are the nature of the control deficiency, what the impact was, ultimately what caused it, and how it was identified. So again, I think that this is just something to be mindful of. Focus on what could have happened versus what did happen. And with that, I guess I'll pass it back to Andrew.
Great. Thanks, Jason. If we could go to the final polling question, I am cognizant of time here, but very interested in the responses to this question. So the PCAOB plans to repropose the auditor's report standard in 2015 to define critical audit matters. Do you think these reproposed standards to the audit report will result in increased value to of the report to an investor? Yes, no, or not sure? And as we wait just for people to respond to that, I will do some of the closing remarks here quickly and just to let you know that we do appreciate your feedback. And there is a survey icon that appears in the bottom right-hand corner of the screen. So please do click on that icon and complete the survey. We take these surveys very seriously, and it helps us understand what we should be doing in future webcasts. And just aware of the time, and unfortunately we will not have an opportunity to get to any of the questions that have come in today. But with that, if we could go to the response to the final poll question, please. So it certainly looks like the standard people want to see the critical audit matters and understand and should be helpful to an investor. The one challenge we do see from an auditing perspective and a standards perspective is getting feedback from market participants. So this is very helpful, at least from our perspective, to understand that. So just closing off today, I'd like to thank again our speakers, Deanne Kennedy, Sean Morrison, and Jason Novakovski. We hope you found this webcast helpful and informative. If you want additional information, please visit our website at www.deloitte.ca. And if you did have questions today that unfortunately we did not get to, please reach out to your Deloitte partner or Deloitte contact so they can help you resolve any questions or concerns you may have. And to all of you viewing our webcast today, thank you for joining us. This concludes our Bringing Clarity to SEC 2014 highlights from the AICPA National Conference on Current SEC and PCAOB developments webcast. Thank you.